The broadcast is now starting. All attendees are in listen-only mode.
Hello, and welcome to the Apparel Sector webinar. My name is Jerry Machado, and with me are Jim Rice and Emily Manley. For today's program, we're going to start by covering some industry trends, review key performance metrics, go over the spotlight companies, and finally, we'll wrap up with some of our debt metrics and the outlook for credit ratings. If you have any questions, we will have some time at the end, so let's get started. 2022 was almost a normal year for apparel, and I mean normal in a good way. As you can see on the graph with the green and blue lines, you have to go back to 2017 to 2019 to get something like normal. Starting in 2020, we had the COVID lockdowns, followed by a surge in demand, the government stimulus checks, the famous stimmies. Then you had supply chain disruptions, congested ports, high transportation costs, and we entered the second half of 2022 with a pullback in apparel spending and bloated inventories. The 2022 holiday season came in below expectations, with apparel sales up 4%, which is below the inflation rate. And even to get those sales, retailers ran promotion with higher average discounts. One bright spot was e-commerce, which was up 10% during the holiday season. So between higher markdowns, higher wages, logistics costs, e-commerce returns, profit margins will likely decline. And with few exceptions, most of our covered companies are expecting a weak fourth quarter, particularly those that cater to low-income customers, whereas retailers to wealthier clients will be less affected. Now, given the high inflation and consumers looking to stretch a dollar is giving rise to the retail and the rental boom.
In the last few years, we've seen the pickup of the resale and rental boom trend. This trend originated with third-party marketplaces like Poshmark and ThredUp, where consumers like you or I could sell items, mainly apparel, that they no longer wanted or needed in their closets. Retailers saw an opportunity here, so companies like J.Crew, Lululemon, Athleta, just to name a few, have started their own resale marketplaces on their e-commerce websites. This has allowed retailers to reach their existing customers and also attract new customers who perhaps couldn't afford or didn't want to pay full price. This trend is especially important in our current inflationary environment, as lower prices in the resale market have helped consumers stretch their dollar. Now, if you look at the chart on the right, you'll see the second-hand apparel market is expected to continue to grow. In fact, it's expected to grow 8% faster than the overall apparel market. The other trend taking hold is the rental space, where companies like Rent the Runway and Amazon are competing with traditional apparel retailers by offering subscription services. Services like these help extend the life of apparel and prevent them from ending up in landfills. So that takes us to the next trend of slow fashion, where consumers buy fewer items of higher quality in order to catch up with their ethical standards. So this is in opposition of the fast fashion trend that we saw take hold with companies like Forever 21. Retailers are starting to market their sustainability, including the textiles being organically grown, fair working conditions, etc. So while despite these slow fashion products having higher prices, we see this offering resonating with consumers, particularly higher income consumers. And that's why we believe the slow fashion and environmental commitment is here to stay.
Okay, turning to the outlook for apparel in 2023, and I guess we can say the outlook for apparel, retail, and the economy is very uncertain. And it may sound like a cop-out, but there are so many competing headwinds and tailwinds, it's really difficult to get a handle on where retail is headed. For instance, the labor market remains really strong. The economy is creating over 200,000 jobs a month. Unemployment rate in January fell to 3.4%, which is a 50-year low. And wages have been rising as companies are trying to attract workers. So, very positive stuff there. The GDP grew 2.9% in Q4. So certainly indicative of a fairly robust economy. As we got into this year, end of 2022, looking ahead, most economists saw a very weak first half of the year, with a majority of economists predicting a recession. As things have played out, some people are pulling back on that. Goldman Sachs and the International Monetary Fund have both now predicted that the U.S. will not fall into a recession in 2023. Getting all kinds of conflicting signals. I think there are some very big red flags out there, however. Consumers are chipping away at their savings. Savings went to historic highs during the pandemic, and consumers are starting to take that money and spend it now. Also, consumer debt has risen. And matter of fact, something just came out a couple of hours ago. Consumer debt for the fourth quarter rose by $61 billion to $986 billion, which is an all-time high of credit card debt. I think even more concerning and a big waving red flag is that delinquencies are starting to rise. And then, on the flip side of that, you saw January retail sales came out today, the National Retail Federation, and said sales rose 4.8% in January, with apparel up 2.5%. So again, so many conflicting signals that it's really hard to predict. I think retailers, by their buying patterns, were projecting a very weak first half of the year, buying inventory very conservatively, as a lot of you know. So I think what we're going to see is a very erratic economy for the first 9 months of the year, with a lot of ups and downs. You see surprises like January with sales better than expected, and I think we'll see some months with sales going to be worse than expected. Inflation's still a factor. It eased a little bit, but still at 6.4% on an annualized basis in January. And the Fed's target is around 2%. So we're probably looking at additional interest rate hikes. So what I would keep really focused on would be looking at where inflation goes and how the Fed reacts to that. And, I think, after the volatile first 9 months, I think things will stabilize in the fourth quarter and we'll see some slow improvement. But it's going to be a very interesting, unpredictable year in apparel and retail in general. And now we're going to go through some metrics.
So let's go to sales. Sales are a mixed bag. At the top, we have H&M, the largest retailer. It had a strong fourth quarter top line growth of 10%, and for the full year, it's up 12%, and that's even after exiting Russia, Ukraine, and Belarus. But those higher sales came at the expense of gross margin, which was down about 550 basis points in the fourth quarter. The gap was down 4%. It did manage to grow sales 2% in the third quarter, but expects fourth quarter sales to be down mid-single digits. Now, with no stimulus checks or child tax credit payments and higher prices, the companies that cater to lower income customers or on tight budgets like City Trends, or sell to young families like Carter's and Children's Place, or young teens like Tilly's and Zoomies were all down year to year, year over year. However, companies that cater to the wealthier clients or have a strong brand appeal are doing better, and perennial favorite being Lululemon, which was up 28%. Another Canadian company that's been growing very fast, especially here in the US, is Aritzia. Sales were up 52%, but that was because in 2021, the Canadian lockdown orders and limited operations of stores were longer than here in the US. So they were increased, but from a lower base. We have then Stitch Fix and Revolve Group at the bottom. Those are our e-commerce retailers. Stitch Fix is one of our spotlight companies, and as you can see, sales were down in contrast to a competitor, Revolve, which had healthy sales growth.
And as you can see here, if you look at Chico's, smack dab in the middle, they had a noticeable increase, and that's in line with the turnaround story there. Sales increases at Chico's were driven by their Chico's and White House Black Market banners, while their Soma banner continued to lag. Shifting over to store count.
Yeah, around 52% of the monitored companies reported more store closing than opening. And companies with sizable closures are H&M. Again, that was mostly related to exiting a war zone. The Gap continues to scale back Gap banner stores while growing Old Navy. The company is exiting its overseas operations to streamline its cost structure. Through the third quarter, it had closed 132 stores this year, mostly in Asia. And it also transferred Gap France, Gap Italy, and the UK to its overseas franchisees. Lululemon keeps growing. It added 71 locations. And let me mention that many retailers took advantage of the pandemic to improve store economics by renegotiating better lease terms or exiting marginal locations. Children's Place is an example of that, and it closed 45 location as its online business continues to grow. Let's move. Okay, so comparable sales. Well, this chart needs a little bit of background and explaining, because during the pandemic, most companies stopped reporting comparable sales. The companies that did report for 2021 reflect a huge surge in demand, which were above historical levels. Last year's comps were near 29% for the sector, whereas this year's average comp is only around 2%. So, for example, take the Buckles in the middle. Buckles comps last year were up 57%, and this year they're down to around a more normal 3%. The companies at the top, the blue lines, were the strongest. Aritzia, Chico's, and Lululemon, and you see that there's no gray bar behind those because they didn't report last year. The companies at the bottom, like City Trends, Tilly's, Children's Place, Carter's, and even Cato, which cater to the lower income clients, reflect the pullback in discretionary spending this year. And as footnoted at the bottom, many companies have still not reported comps, Abercrombie & Fitch, American Eagle, to name a few. So for 2023, since this past year was a more normal year, we hope that the companies start resume reporting comparable sales year over year. And that brings us to our spotlight company, Destination XL.
Destination XL is really the perfect example of a true turnaround story. Early in the pandemic, the company went into somewhat survival mode when they had pretty low liquidity. They were delisted from the NASDAQ, among other things. But since then, they've managed to turn it around. Now, this company we once had rated at an F1. That's one of our lowest credit ratings. And we've now rated them a C1. DXL has got a bit of competitive edge here because it's really the only nationwide retailer that caters to the big and tall men's market. And even though you have retailers like Macy's and Kohl's, those retailers typically have inadequate offerings, low on inventory, frequent out of stocks, etc. So Destination XL has been able to really corner their market. They've really invested in marketing and personnel. And with that, in its turnaround, the company has also been pruning their store base. So over the last 5 years or so, they've closed about 125 stores. The pruning of its store base, that paired with its ability to maintain full price selling. So even amidst this promotional environment that we've seen recently, Destination XL has really not been promoting or discounting. And so that's allowed them to maintain and even expand their EBITDA margin. So if you look at the chart on the right, you'll see their EBITDA margin skyrocketed compared to their historical levels. And while we do expect to see this start to normalize a little bit, we really see it staying well above their historical levels.
One of the things that, I'm sorry, I mean,
Sorry.
one of the things that aided the company was during the pandemic, their customer base grew, and that is a little bit of a pun because we know there was a lot of weight gain during the pandemic when people were stuck inside, and actually expanded, again, another pun, their customer base. So that's they've had some other things in their favor, on top of, I think, doing a much better job merchandising.
Yeah, and I'll just add on to that is that the company has been able to pay down their debt, so their balance sheet's looking pretty strong. They have no debt and roughly 114 million in liquidity. So we see this company continuing to do well, even amidst the uncertain economic environment. Now we'll shift to the store trends just quickly. This is one of our services that allows you to see store concentration across the United States. And you can also see openings and closings by state. With Destination XL paring back their stores, they've also been converting their legacy stores of Casual Male XL into their Destination XL banner. So the company stated that they continue to plan to do this, and ultimately they should all be in the DXL banner. It looks like their store contractions starting to slow, and they'll start to return to store expansion in 2023.
Real Estate Intelligence is a new service that we've added. It's a mobile data platform that tracks foot traffic. It has national coverage, but can identify traffic at the individual store level. So for example, for Destination XL, its top store, its busiest store, is located on Shelbyville Road in Louisville, Kentucky, and it had 453,000 visits. And the company's least visited store was in Louisville, Texas, with only 15,000 visits. The charts on the right, the green, show the top 5 stores in terms of foot traffic. The chart on the bottom in red shows the stores with least traffic.
And as you can see on the left-hand side, the foot traffic compared to pre-pandemic for Destination XL is up almost 10%. So that's consistent with the turnaround story, their improved marketing. And even going back to 2018, it's up over 7%. So really strong store traffic. Turning to gross margin, across our coverage, gross margins essentially deteriorated pretty much across the board, with a few exceptions like Destination Excel and Chico's. Those are two retailers that were able to maintain their full price selling. However, for the most part, the promotional environment did eat into most of our retailers' gross margins. But we do have to remember that last year, gross margins were elevated above historical levels, and that's due to a number of factors. So last year we had supply chain issues where inventory was in short supply. This allowed retailers to have low markdowns, really no promotions, and there was also high demand. So consumers were really looking to get back out shopping. They also had built up savings from the stimulus money, padding their wallet. So overall, it was a tough comparison to last year. And then paired with the promotional environment this year, that explains the gross margin normalizing this year. Last year's average gross margin was 45.3%, and now it's down to an average of 43.2%. We've got Gap, and you'll see Gap has the largest decline. That was, not only was there inflation and higher raw material costs, but there was a large markdown with their Yeezy Gap partnership fading away. While we also have Chico's being the largest increase, and that was due to the customer willing to pay high prices for their value offering. Turning to SG&A, on average, SG&A was up about 110 basis points across our coverage. And over the last year, retailers have been plagued with higher operating costs. So inflation, higher wages, increased raw material and fulfillment costs. I mean, the list goes on. So these higher costs paired with lower sales explains why retailers' margins have been under pressure. So going forward, although there will be some relief from supply chain costs, we do expect these higher costs to continue to pressure margins in the first half of 2023. So looking forward, retailers are really going to have to focus on realigning their cost structures in hopes that they can maintain their profitability and their margins.
Okay, and as you'd expect, as we've gone through the sales issues and gross margin contraction and higher expenses, that's going to impact EBITDA. And going back to Emily's point earlier, last year was an abnormal year, was an aberration, and a lot of companies produced record EBITDA numbers. So we knew this year there'd be some kind of pullback. But taking a look at the sector here, we've seen a decline overall in the sector. But actually, it's pretty healthy. To benchmark it, we'd like to see an EBITDA margin of 10% or higher. I think anything 7.5 or higher is not too worrisome. And you can see quite a few here in the sector above those numbers. Victoria's Secret still has a pretty healthy EBITDA margin of 14.5%, at a fairly steep decline. Now, that was a company that kind of got lazy and didn't notice that the world around them was changing, and the competitors started to grab market share. They made some adjustments, had a much better year last year, and things have started to decline a little bit this year, but they're still generating almost $950 million in TTM EBITDA. So significant improvement there overall, even though it's down year over year. They did recently raise Q4 guidance, even though Q3 was a little tough, and significantly they're in the process of acquiring Adore Me, which should help their digital growth quite a bit. They're also instituted some significant cost reductions. So we think it's still a turnaround story, and we have no credit concerns there. Some of the companies at the bottom here we've discussed or are going to discuss. And Cato is one with a much lower EBITDA margin than it had. That was another big drop. As Jerry said earlier, companies on the lower, with customer base at the lower end of the socioeconomic stand have not performed as well. And the real underperformer here, and the only company generating a negative EBITDA margin, is Stitch Fix, which has some business model issues, and that is our next highlighted company.
So Stitch Fix is an example of a promising company that expanded too fast in attempting to grow market share. Sales were boosted by the pandemic when everybody was indoors and shopping online was the only entertainment. The company's subscription model married data science with a human stylist, and the theory was that that combination would deliver clients a curated selection of merchandise that was personalized for them. But to gain broader appeal, Stitch Fix introduced a complementary service called Freestyle. And Freestyle allows a customer to purchase merchandise without the subscription service. By adding Freestyle, a regular customer can go on and purchase just like any other e-commerce retailer. So Stitch Fix lost some of its differentiation mojo. It now appears that Freestyle is cannibalizing the subscription business. Sales have been dropping, and EBITDA has fallen off a cliff. Active clients have been declining as consumers have returned to the stores following the pandemic, and revenues per active clients, which is basically order size, is also coming off pandemic peaks. But some of the fall off could also be due to inflation biting into consumer wallets, and also it could be overpriced products or quality issues. In its most recent quarters, sales were down 22%, EBITDA loss was $7 million, and free cash flow went to negative $16 million. Now, on January 5th of this year, the old CEO stepped down, which was the right move. And the founder of the company, Katrina Lake, is back as interim CEO. The company has not made a formal turnaround plan, but it's clear that it's cutting expenses to optimize the cost relative to falling sales. So for 2023, management doubled its cost reduction targets to $135 million. And to pursuing that, there was a 20% staff cut last January, following a 15% staff cut back in June 2022. The company is also narrowing its offering. It closed 2 manufacturing plants in Pennsylvania that were dedicated to plus size apparel. There was just not enough demand. And it's also exiting sustainable merchandise. And it's closing a distribution center in Utah. So for the next quarter, guidance is for revenues to drop another 20% and adjusted EBITDA to range between negative $5 million and positive $5 million. So finally, Stitch Fix is facing competition from other personalized styling service. The main competitor, we think, is Amazon's personal shopper by Prime. The other alternative is Revolve, which we've seen is doing very well and profitable and growing. There was also some rumors that Stitch Fix might be a possible M&A target. And at this moment, we don't think so. It's like catching a falling knife. Maybe in the future, when the company starts hemorrhaging clients and sales recover, and the company returns to consistent break even or better, maybe. But at the current moment, the the company is struggling, and its ratings may be downgraded in the next couple of quarters. So
Jerry,
let's.
I think another problem here is that, and it's also for all online only retailers, it's become very expensive to acquire customers, and the cost of that has gone up, and I think that's reflected in their SG&A.
Yes, yes, well, yes, well said. They are actually looking to cut some of their marketing expenses to improve profitability. So moving on to SG&A margin.
CapEx margin.
CapEx margin, yeah.
Right. So what we saw during the pandemic was understandable. Companies cut way back on CapEx as they were conserving cash, not knowing how long the lockdown was going to last. And so understandably, CapEx spending went up considerably last year to more normalized levels. A lot of that was, we saw early on the earlier slide, there was some store expansion, especially Lululemon, which is, leads in CapEx margin. But generally speaking, it was investments in infrastructure and technology as companies are trying to hone their omni-channel process and improve the online experience. So we're expecting to see probably even more investment in 2023 as companies, you need to invest to remain competitive. And the ones we like to see around 2% or so, that's a normal. And getting back to Destination XL, they had really cut back on CapEx when they were struggling in survival mode. So companies like that starting to spend more normally again. So, and we can see the increase was 2% last year up to 2.9% this year. And Stitch Fix is a good example. Sometimes when companies are struggling and they cut CapEx, it's an easy thing to do. It's a short-term fix, but in the long run, cutting capital spending never seems to work out. So turn to free cash flow. This chart is actually free cash flow as percentage of sales. I prefer looking at free cash flow and cash burn directly, but cash flow decreased significantly in apparel retailers this year, and last year was one of the strongest cash flow years ever. I think Emily spoke to it a little bit before. A lot of it had to do with the lower inventory levels. So a few factors driving the cash flow issues this year, and I think it will normalize in 23, was the higher inventory levels. So in 21, people couldn't get enough inventory. Last year, supply chain kind of worked out quicker than people thought, and inventory levels got bloated. So a lot of inventory. So the working capital component of free cash flow had a very negative impact on cash flow. As we just said, capital spending increased, which is part of free cash flow. So in some cases, capital spending doubled. So it had an opposite effect this year than last year when capital spending was real low. And then there was some normalized credit terms during the pandemic. Some companies received longer than usual terms to help them out. Some of that carried into last year, and I think most dating is back to normal again. So it's been a lot of negative free cash flow that we normally don't see. A couple of companies, obviously we just discussed Stitch Fix and their issues. Abercrombie generating some significant trailing 12-month free cash flow. Not worried about Abercrombie. It's still rated C2, but we do expect the cash flow situation there to turn around. They've always been a cash flow generator. And some of these other companies we're going to be discussing going forward. And here, we picked out 4 companies to have a brief discussion on. Two privates and 2 publics. I just like to say sometimes if you're looking at our site on a private company and we don't see information, we may have information. We may not be able to publish it because of NDA or other issues. But if you're looking for a company and you don't see it, I would check with the analyst to make sure, because we may have information on it. So first up is Tailored Brands. Tailored Brands filed bankruptcy, a victim mostly of the pandemic. They did have kind of a leveraged balance sheet, but a lot of it had to do with the pandemic and weddings and proms being canceled. They almost didn't come out of 11. They did, ran into issues right away, but nice turnaround story with the return of occasion events, as I said, proms and weddings, and a number of people going back to the office led to improved sales. So the 9 months of this year, sales were up nearly 30% to $2.2 billion and generated nearly $300 million of EBITDA. So huge improvement there. Liquidity is currently over $220 million, including $90 million of cash. Last year, they were trying to refinance some debt, probably waited too long, and interest rates got away from them. So this year, they used some of that excess cash from free cash flow and paid down a $75 million term loan and a portion of a $365 million term loan. Still operating over 1,000 stores and was recently upgraded by S&P. So we don't have a rating on it. We don't have full financials, but a nice turnaround. Q4 is not their better quarter, but we don't see any near-term concerns here. Lands' End is public. It was a company that was really hit by supply chain issues, had a lot of problems getting merchandise in, just all private label. The year-to-date revenue decline isn't that significant, 5%, but EBITDA is down almost 50% due to significant markdowns taken. Inventory is up 18% year over year. They got some early receipt of holiday inventory, had some carryover from prior seasons, and they're not expected to get inventory back to normalized levels until the end of the spring-summer season of this year. So still some gross margin danger here for the balance of the year. Expect to see more markdowns. Some pretty significant cash burn for a company this size. Liquidity is $134 million, and their debt is a $247 million term loan maturing in September 2025. So they do have a couple of years before that matures. They've lowered guidance several times this year and are now projecting a net loss and about a 45% decline in EBITDA year over year. So I don't think Lands' End's an immediate credit concern, but given the trends and the fact that margins will remain under pressure probably for the first half of the year, I think something to watch closely. Express, another public company that received a little boost when special occasions returned. That's in their business model. Year-to-date sales are up, but had a very weak third quarter when revenue fell 8%. It was due to weakness in the women's business and the slowdown we saw in discretionary spending in Q3. Q3 EBITDA turned negative, and year-to-date EBITDA is down nearly 50%, only $26 million. It's a pretty significant cash burn, and ended the quarter with $72 million of liquidity. I think the key here is subsequent to the end of the third quarter, they announced a strategic partnership with WHP Global and received $260 million in gross proceeds. They paid off their term loan, so now their only debt is revolver borrowings, and they're also going to use it to invest in the website, which WHP has a lot of knowledge of. And I thought this was interesting, talking about future M&A activity. So the settings some money aside for a potential acquisition. So I think the partnership with WHP took any credit concerns in the near term for Express off the table. And then finally, Route 21, who is private. They're privately held, as I said, very little financial information is available. This is a Chapter 22, which means they've already filed bankruptcy twice, most recently in 2017. They had a very strong year in 2021, as we know most retailers did. In early 2022, sponsors took out significant dividends, weakening the balance sheet, and then operations deteriorated from a combination of their lower end customer being impacted and some merchandising changes they've made that didn't work out. So they were having liquidity issues in the middle of the year as we headed into fall. Late in the year, they entered into a new $25 million term loan to enhance liquidity, and we've heard that recent operations have shown some improvement. The term loan also has a feature where it doesn't they're not required to pay any cash interest during 2023 to give them more of a runway. But this remains a concern, more of an quarter-to-quarter credit. If anyone has any concerns or questions on this, they could contact me, because we can't publish all the information we have. But it remains a concerning credit. So it's an update on for interesting apparel retailers. And we have the stock chart, and we try to stay away from equating stock price to creditworthiness, because it doesn't always correlate. There's a lot of reasons a stock could rise or go down outside of their fundamental business, as we've seen with the meme stocks and what's going on with companies like that. Even the recent Best Buy situation, stocks did fall 21% for the year, year over year, as opposed to the S&P index. So apparel performed worse, which is kind of understandable, and some of it's performance related, but I don't want to spend a lot of time on this as we're running short on time. So we're going to go into our warning signs now.
Revolving lines of credit are there to provide liquidity and smooth out cash flow seasonality in operations. And as creditors, we prefer lines of credit not to be used to finance share buybacks or pay dividends, but sometimes companies do that. For the most part, most of the companies here have plenty of liquidity. Some of the ones that show some declines related to usage for inventory purchases, financing working capital needs. Children's Place is one related to that, and the company that we'll focus on is on the lower Stitch Fix. As you saw, that company normally has 100% revolver availability, and this year they uncharacteristically issued letters of credit, so we're looking at them. But otherwise, most of the companies have had plenty of liquidity online, and as you can see from the prior years, since there was such strong cash flow, they had higher liquidity levels last year than this year.
And I would note that Express at 16% was before they received the infusion from WHP. So expect improvement in that, especially going to Q4.
Okay, moving to one of the warning signs that we look at is we like to see total debt to EBITDA below 3 times. And for the most part, most of the companies here are below that level, below that threshold, with the exception of Express and Land's End, which Jim talked to.
And the Land's End debt is mostly due to revolver borrowings and the lower EBITDA levels.
Interest coverage is similar stories we have here. We'd like to see interest coverage above 3 times. And for the most part, most of the companies are there. Again, it's Land's End is the one that has fallen below. And Express
It's a
seems
pretty
to
healthy
be
sector.
pretty
You see
healthy
how many
coverage.
how many companies don't have any debt at all, and you know, with an average of 18 times coverage, that's from a debt perspective, very healthy sector.
And this finally gets us to the credit ratings and our outlook. So overall, the apparel retail sector struggled in the second half of 22, where there were more credit downgrades than upgrades. For most companies, the downgrades were not balance sheet debt related. It was more operational, lower comps, lower sales, margin pressure. And most of the C1, C2 downgrades fall into that category. And then you have Gap and Stitch Fix that are struggling at the D1 levels, and we'll be probably looking at some sort of rating review in the next couple of quarters.
We have a question about the ratings, asking what do we anticipate the trend this year will be with the credit ratings? Are there going to be a lot of downgrades or potentially upgrades?
Well, given the uncertainty and of the economic outlook, we certainly know that wages are going up, operating costs are up, and companies need to then restructure operations to maintain their profitability. So it's not a balance sheet issue, it's a question of how operations are, and we think at least for the first half of this year, there'll be pressure on operations which will affect the ratings. So, in particularly the ones that are most vulnerable and which are in the D categories.
Yeah, a couple of I would agree, and it's interesting. We said retailers have purchased inventory so conservatively. If there are some months like January where sales do surprise to the upside, if they may be leaving some sales on the table by being too conservative. But again, the retailers are in a difficult position because, as we said, so unpredictable this year, and they don't want a repeat of last year where they had bloated inventory levels. So it's going to be an interesting dynamic, getting enough, keeping the inventory to sales levels where they're supposed to be. Does anyone have any additional questions out there? You can always, our contact information is below. Always contact us with questions if something comes up. And again, as I said, if it's a private company you're interested in, you don't see it, please let us know because we may have some information on it. So I think that's it. Thanks everyone for joining us.
Thank you, everyone. We hope you have a great day.
Bye-bye, everyone.